All right, future CPAs, welcome. Today, we are going to tackle a topic that you are guaranteed to see on the CPA exam: fixed overhead variances. Now, I know it can seem a little tricky, but trust me, we're going to build a super simple tool that's going to make it all click. Let's dive in.
First things first, forget about just memorizing a bunch of formulas. That's not going to help you 3 years from now on exam day. To really get this, you got to think like a manager. And what does every manager need to run their ship? A dashboard. So right now, that's what we're going to do. We are going to build one together, just for fixing overhead. So what's this dashboard even measuring? It really just boils down to two key questions. Two things any plant manager would want to know at a glance. Question 1, did we spend what we plan on spending for stuff like rent and salaries? And question 2, did we actually use our factory as much as we thought we would? That's it. It's all about spending and utilization. Okay, let's picture it. Our dashboard has two big dials. The first one is the spending dial. This one's super easy. It just looks at what you actually spent versus what you budgeted. Simple. The second one, though, is the capacity dial. Now, this one's a little different. It has nothing to do with how much money you spent, but everything to do with how well you use the factory space and machinery that you are paying for. Now look, before any dashboard can give you useful info, you have to set it up, right? You've got to calibrate it. You need a benchmark to measure against. And in the world of cost accounting, our benchmark is called the predetermined overhead rate. This one number is absolutely crucial. It sets the standard for the entire year. And getting this benchmark is just a quick 4-step process. First, you pick your time period, usually a year. Second, you pick your allocation base, like how are you going to spread these costs, maybe per machine hour. Third, you add up all your budgeted fixed costs, all the rent, the insurance, the salaries. And finally, you just do the math to get your rate. And this formula right here, this is the engine of our entire dashboard. You just take your total budgeted fixed costs and you divide it by your total planned activity level. That gives you one powerful number. Something like, say, $6 per machine hour. This little rate is how we're going to apply or absorb our fixed costs into every single product we make. Okay, dashboard's calibrated. Let's check our first dial, the spending variance. This one answers that really simple question. Did we stick to the budget or not? The budget variance, or as it's sometimes called, the spending variance, is, well, it's exactly what it sounds like. It is purely the difference between the actual bills you paid and the budget you set at the very beginning of the year. There's no fancy stuff here. It's just about controlling your cash outflow. And honestly, the formula could not be easier. It's just your actual costs minus your budgeted costs. That's the whole thing. If you spent more than you planned, it's unfavorable. Spent less, favorable. This is by far the easiest part of this whole topic. So for example, if our actual spending was $285,000, but our budget was only $276,000, that's a $9,000 unfavorable variance. On our dashboard, this dial is flashing bright red. It's screaming, we overspent. All right, one dial down. Now for the second and, honestly, the more interesting one, the capacity dial. This is also known as the production volume variance, and here is the most important thing you need to remember. Forget about spending. This dial is all about utilization. How much did we actually make? So what is it really? The textbook definition is the difference between your budgeted fixed overhead and the overhead you applied to production. So remember that rate we calculated earlier? This variance pops up when we use that rate on the stuff we actually built and then compare that total back to our original budget. Let's look at the numbers here. Our plan, our budget, was $276,000. But based on how much we actually produced, we only applied $230,000 of overhead to our products. The volume variance is just that gap between the plan and what our actual production earned. That's the comparison that matters. And that gap is $46,000 unfavorable. Now, wait a minute. Why is it unfavorable? It's not because we spent too much money. It's unfavorable because we produced less than we planned to. Our capacity dial is telling us we paid for this huge factory, but we didn't use it as much as we said we would. This right here is the golden nugget for your exam. The volume variance is not a spending variance. I'll say it again. It's not a spending variance. It is purely a measure of utilization.
It tells you one simple thing: were your machines running like you planned, or were they just sitting there, quiet?
And this graph shows it perfectly. See that flat line? That's your budget. You pay that rent and those salaries no matter what. The diagonal line? That's the overhead getting earned or applied as you make more stuff. When you produce less than you planned, you get a gap. That gap is your volume variance. It's literally the cost of the factory capacity you paid for but didn't end up using.
Okay, so we've built our dashboard, we've seen how the dials work. Now, let's lock this in. Let's boil it all down into a brain hack, a little cheat sheet designed to stick this in your long-term memory for the LEPA.
Here it is, your brain hack. The budget variance is just actual spend versus planned spend. Easy. The volume variance is actual production versus planned production. The key number driving all of this is that denominator level you picked way back in the planning stage. And for a manager, the volume variance is about utilization, not spending. And finally, your big CPA alert. Unfavorable volume variance means you produced less than you planned. Favorable means you produced more. Do not get those twisted on exam day. So I'll leave you with this final thought. Our dashboard showed this big unfavorable volume variance, which sounds awful, right? But what if the managers slowed down production on purpose because they knew customers weren't buying? I mean, making a ton of inventory that just piles up in a warehouse is not good business. So is that unfavorable variance really a sign of bad management? That's the kind of critical thinking that takes you from just knowing the numbers to being a real CPA. Something to think about.